Hi everyone, welcome to the live stream today. Very much excited for having you. It's a new day. We want to continue with our discussion on the standard costing and variance analysis. Like I mentioned, this is one of the key areas, one of the key topics that you need to understand when it comes to management accounting, either doing F2 or F5 or doing introduction to management accounting in the ICAG or management accounting proper in level 2. I see some of you guys joining. Welcome to the stream. Give us a thumbs up when you join the stream. That way we get more engagement on the video, and YouTube and Facebook will be able to push the video so we can reach as many students as possible. This is the part 3 of our lecture on standard costing and variance analysis. I've left it in the description, so you can check the description to this video and you will get the part 1, the part 2. Then when you watch the part 3, you will be able to build up your knowledge in relation to that. So welcome to the stream. I see some of you coming in there. Welcome. Smash the thumbs up button. Give us a thumbs up on the video on YouTube, on Facebook. That way we get more engagement on the video, and YouTube will push the video so we can reach as many students as possible. Now, I see some comments already coming in as well. Let me also say a very big thank you for you guys who wished me a birthday and your messages on Instagram, on Facebook, on WhatsApp, some of you here on YouTube. Thank you very much. I really, really appreciate your wishes, your prayers, and all the messages you sent to me. Thank you very much. God bless you, and thank you for supporting and continuing to be part of the Team Nhyira Premium and the community that we are building here. Thank you very, very much. You guys are awesome. And remember, we are celebrating. I told you on Monday that this week is a celebration week because we were celebrating 7,000 followers of you guys on YouTube or subscribers on YouTube. And yesterday was my birthday. And so the whole week, you know, we are just in the celebration mode. And we're going to be doing some offers, some free, some giveaways today on the stream. So make sure that you stay connected. Make sure that you stay put as you'll be able to participate in the stream. Martin Augustine said, good afternoon, sir. I'm waiting. Okay. Labi Benjamin said, good day, sir. Please, I hope you are doing well. I'm patiently waiting for today's live stream. Okay. Job said, good evening, Nhyira. We are patiently waiting. Okay. Al Hassan Ali Baba said, good evening. I hope you are doing well. Yes, Ali Baba, I'm doing well. Jeremy Rush said, good evening, sir. It's good to be here again, all the way from Liberia. Right. Welcome, Jeremy Rush. Nicole Williams said, good morning, sir. Good morning, Nicole. I hope you're doing well. George Amofa said, I am seeing some 200 Ghana. Yeah, George, you saw the 200 Ghana with what message, man? I'll come back to that in a moment. Peterson said, wow, happy belated birthday, sir. Best wishes. Thank you very much, Peterson. Nicole Williams said, yes, sir, we need a celebration. You know, see, that is awesome, man. So thank you very much, you guys. I really, really love this community. Really, really love the things that you guys do for us here. For those of you who are staying subscribers, for those of you who like the video, for those of you who keep sharing the video, all of you, God richly bless you. And the team is working on a lot of things for you guys so that you can really, really benefit on what we are doing here on the channel. Now, so we want to go into the discussion, and today, number one giveaway for this week is going to be a discount on our executive revision masterclass, and you can see that displayed on the screen already. And George Amofa referred to that in his chat. Our executive revision masterclass is actually 325 cedis per paper, but for a limited time in the next 24 hours, if you call or WhatsApp 050-114-9296 and register, you'll be able to pay only 200 Ghana cedis per paper to be able to be part of our executive revision masterclass for the ICA November 2020 examination. Now, this executive revision masterclass is going to give you access to all our lecture videos. So you get access to my complete lecture videos of the 14 weeks so far that we have covered on whatever subject it is that you are writing. You get access to our ebooks catalogs, our question kits to be able to download them. You'll be able to also join our Zoom sessions prior to the revision session actually starting, and also you will be able to get that personalized one-on-one mentorship session with me, so I can hold your hand, mentor you, direct you, and assist you to be able to prepare well for the examination. So if this is something that you are interested in, something that you want to be part of and get a full benefit of whatever it is that you need in order for you to pass the examination, for only a few students will be given or will be getting this offer, 200 Ghana cedis. So instead of 325, that is being sliced down to just 200 Ghana cedis. So you can join us and prepare for the November 2020 examination under my mentorship in relation to that. So you can call or WhatsApp 050-114-9296 and you register and be part of it. Right, so let's get into our discussion for the day, standard costing and variance analysis. And we're looking at the question that we were solving on Monday. In case you don't have it, it is already posted on my Instagram page, correct? And if you have the ICA question kit, let me grab that. If you have the ICAG question kit or question bank, it is question 28 on page 20, correct? And that is the question we are looking at. I'm going to be sharing my screen with you as well for you to see the question we are solving so that we will be able to go through together. Now, comment in the chat box any questions you have for me. Maybe you watched the part 1 or the part 2. You didn't understand something, or maybe there is a topic or something you would want me to share my thoughts on. Put it in the chat box, put it in the comment box. As we are preparing for the revision, as we are preparing for the exams, let me know the key issues that you would want me to be talking about on the live stream from next week. Give me topics, don't give me subjects, give me topics. So what are the topical areas you would want me to share my thoughts on, you would want us to solve some questions on? So just put them in the chat box. I'm going to take notes of all of them, and I will be preparing questions for them so that we can answer all of them on the live stream. Emmanuel Frimpong said, happy belated birthday, sir. Thank you, Emmanuel Frimpong. Ernest Ampofo said, boss, kindly treat transfer pricing. Okay. Now, when you say transfer pricing in what? In management accounting, in taxation, or in what? I guess you are referring to transfer pricing in management accounting. Okay, under performance evaluation. So let me grab, let me add that to my question topics here real quick. Transfer pricing. So comment in the chat box. I want to know what questions, what topics would you want us to cover from next week as we gear towards our revision sessions and prepare for the examination. So let me put this on my notepad real quick. Let's see. So transfer pricing, under performance evaluation. Okay, I got that there. Esther Akosa said, hello, good evening, sir. Hope you are doing well. Yes, Esther, I'm doing well, and I hope you are also good. Emmanuel Queno said, hello, Nhyira. Please kindly treat transfer pricing in man accounting. Okay, so we get into people coming in with the same thing, don't worry. NS said, yes, transfer pricing in man accounting. Peterson said, sir, kindly treat business valuation in corporate reporting. Thanks. Okay, that's also another interesting aspect. Not only is that in corporate reporting, but also in financial management. So the financial management students will also benefit from that. So business valuation, okay. Let's see. Eric Boabin said, "Hi, sir. I'm Eric Boabin. This is my first time of joining the class, and I hope you are doing good." Yes, Eric, I am doing well, and I hope that you are doing well. There are a lot of videos already on the channel, so you can check the playlist on the channel. We have over 450 videos already available on the channel. So just check the playlist. 9 out of 10 of the topics you would want me to talk about or you are looking for are already covered on the channel. So just check the playlist on the YouTube. Just check the playlist and you'll be able to get access to a lot of videos there in that case. Right, so let's go straight up into the question. Let me share my screen with you. And let's see. Right. So this is the question we've been working on. We started working on Monday, and we did a couple of computations, and I told you that we are using the question as a guinea pig to be able to answer a lot of issues. So there were things that we weren't supposed to do from the requirements of the question, but I brought it up and we computed or we calculated it in that case. Remember, like I said, part 1 and 2 of this lecture is in the description of this video. So when you check the description, you see the part 1, you'll be able to watch it. The part 2, you'll be able to watch it. Then you can watch the follow-up here. So let's catch up real quick on what we've done so far. We've been able to calculate the material price, the mix variance for each of the materials. We've been able to calculate the labor rate variance, the labor efficiency variance, and the idle time variance. We are left with the I aspect of the question, which is the sales volume contribution, and then the sales price variances. Then, in the II aspect, we are also left with the yield variances in relation to that, or the yield variance. So let's go there real quick. Let me explain the concept that you need to understand there in relation to that. Then let's bounce back into the question and build our knowledge on that quickly. So let me stop sharing my screen here, and then let's go through the concept in that case. You ready? So let's go. Now, when it comes to the sales variance, okay, traditionally, it's divided into 2, okay? So we're going to have what is called the sales volume variance, okay? And then the sales price variance. Now, I want you to stay with me carefully on the principles here. The sales volume variance and then the sales price variance. Now, the sales price variance is simply the difference between how much the actual unit should have sold for and how much it actually sold during the period under consideration. That is the concept in relation to the sales price variance. So for whatever unit we've produced and sold during the year under consideration, how much should we have sold it for in terms of the revenue, and how much did we actually sell it? That is what we mean by the sales price variance. Now, with the people, or for you guys who will be interested in formula approach, technically, the sales price variance will simply be equal to, for instance, your standard price minus the actual price multiplied by the actual quantity of products that has been produced and sold during the year under consideration. So that is the idea about the sales price variance. Then we come to the second one, and that is called the sales volume variance. Now, the sales volume variance has to do with the difference between how many units we want to sell and how many units we actually sold during the period under consideration. Follow me carefully because I'm going to drop a bomb here, and I want you to make sure that you capture it very well. The sales volume variance is the difference between the units we want to sell and the units we actually sold. The difference between that gives us the sales volume variance. However, the computation of the sales volume variance is dependent on whether the entity is using a marginal costing system or absorption costing system. This is where the bomb is coming in. So you make sure that you capture it and get it well. The way we calculate the sales volume variance is dependent on whether the entity is using the marginal costing system or the absorption costing system. So what do we mean by that? So this is the idea, basically. Sales volume variance. So we're going to be bringing the budgeted units or budgeted sales, all right? Then we bring in the actual sales. Remember, these are in units, okay? These are all in units. These are all in units. So we less that, then we get a difference. We get a difference. Now, stay with me carefully. If the entity is using marginal costing system, listen carefully. If the entity is using marginal costing system, then this difference in units will be taken as standard contribution per unit. Standard contribution, or if you want, margin per unit. Then when we use it to multiply, we will now get the variance, which is in currency. Does it make sense? Make sure you get a concept very well. This is very, very critical. So this sometimes can be called the sales volume margin variance or the sales margin volume variance. Sometimes we can just do name interchanging, but if the examiner says calculate the sales volume margin variance or the sales margin volume variance, it's actually the same thing, but it means that the entity is using the marginal costing system. For that reason, we're going to be multiplying our difference with the standard contribution or the standard margin per unit. You got that? 2. If the entity is in the absorption costing system or the entity is using the absorption costing system, then we are going to be taking it as the standard profit per unit. You got that? The standard profit per unit. So let me put that pro forma also here. So the sales volume variance, this is if we are in the marginal costing if you want to. Okay? If we are using marginal costing system. But if you are using the absorption costing, then it's going to be a different game altogether. So what do we bring? We bring our budgeted sales. Remember that is in units, as always. We bring the actual sales. Again, that is in units, as always. We're going to less that to get a difference. Then, because the entity is using the absorption costing, we take this as the standard profit per unit. And that will be in dollars. You multiply it up, and you get your variance in dollars. This is what we mean by the sales variance. Okay? This is what we mean by the sales volume variance. So 2 things I want you to understand. The sales price variance is the difference between how much we should have sold what we sold and how much we actually sold it for. Okay? So we should have sold it for this, but we did sell it for this or for that. The difference is the sales price variance. But the sales volume variance is the difference between how many units we want to sell as against how many units we actually sold for the period under consideration, taken at either the standard contribution or margin per unit or the standard profit per unit, depending on the system that the entity is using. Now, if the examiner is quiet, in other words, if the examiner doesn't tell you that the company is using marginal costing or absorption costing, 9 out of 10, if the examiner asks you to calculate the sales volume variance, then you're going to be using the standard profit. Okay, you're going to be using the standard profit, because if it is quiet, then we assume that the entity is using the absorption costing principle. However, where you so choose to go with the marginal costing principle, you've got to state it down that you are assuming that the entity is in the marginal costing principle, and then you do the workings, because the system they are using affects how the results will actually come out. So whilst you are dealing with standard profit here, which means total sales or selling price minus total cost, but here you are just dealing with selling price minus total revenue in relation to that. So that is the idea about the sales price variance and then the sales volume variance. Any questions, please put it in the chat for me real quick. But again, this is where it gets interesting. The sales volume variance can further be divided into the sales mix variance and then the sales quantity variance. So I want you to stay with me carefully here. You see, when an entity uses more than one input, more than one material in the production of goods and services, then the usage variance will be classified further into what? The mix variance and the yield variance. However, if an entity is selling or sells more than one product, okay, if the entity sells more than one product, then in that case, the examiner is going to ask you to calculate the sales volume mix variance and then the sales volume quantity variance. You got to be careful about that. So that will come in where the entity is selling more than one product. So the sales volume variance can further be divided into the sales mix variance and then the sales quantity variance. So let me put the ideas out for you here, and then let's see how we're going to do in relation to that. So if we are dealing with the sales mix variance, what is it about? Now, the sales mix variance has the concept of the material mix variance. So if you remember what we did in on Monday in the part 2 of the series, where we calculated the sales mix variance, it has the same idea when it comes to the sales mix variance as well in relation to that. So let's go with the idea real quick. So like I said, where the entity sells more than one product, then the sales volume variance will be divided into the sales mix variance and then the sales quantity variance. So let's look at these real quick in relation to that. So sales mix variance. So the sales mix variance is simply equal to the standard mix in actual quantity sold minus actual mix in actual quantity sold. And then we take this at the standard profits. Are we in frame? Let's make sure we are in frame. Yep, I guess we are in frame in that case. Okay. So the sales mix variance equals the standard mix in actual quantity or actual quantity sold minus the actual mix in actual quantity sold multiplied by the standard profit. Now, if you remember what we did under the mix variance of the material, it has the same idea of getting the standard mix in actual quantity. Okay? Then the actual mix in actual quantity simply means the actual thing that we sold for the period under consideration. I see a comment coming in from Blessed Ephia Precious. Blessed Ephia Precious, nice name. Please come again with the sales volume mix variances. Okay, I think I took that again. I don't know. Let me know, Ephia, if you are okay with the explanation I re-gave before I saw your comment. So we said that the sales mix variance comes in where the entity produces and sells more than one product. So when the entity is selling more than one product, the first thing we will calculate is a sales mix variance. And that is going to be standard mix in actual quantity sold, and then actual mix in actual quantity sold, multiplied by the standard profit in relation to that. So Ephia, let me know in the comment box if you're good in that case. Then the second one, sales quantity variance. Sales quantity variance. Now, this is going to be your actual sales, just like this one. So standard mix in actual quantity, standard mix in actual quantity sold, multiplied by the, hey, did I say multiply? Minus budgeted sales, okay, times your standard profit. Times your standard profits. Times your standard profit. So that is the sales quantity variance connotes the idea of the material yield variance. Okay, it connotes that it has the same idea of the material yield variance, and we're going to be going through to that in a moment for you to be able to understand it in that case. So that is the sales quantity variance. That is standard mix in actual quantity. The figure you got here, that's the same thing you're going to be bringing down here. That's the trick. Okay, that is the trick in relation to how we deal with some of these variances. The figure you got here, you're just going to bring that here. Then you're now going to bring your budgeted sales from your standard cost card in that case. Then boom, you'll be able to now multiply that by the standard profit in that case. So this is what we mean by the sales mix variance and then the sales quantity variance. Please note, the examiner will ask you to calculate this if the entity is selling more than one product. If the entity is selling more than one product. We good? So that is the idea about that. If you have any questions, you know what to do. Put it in the chat box for me and I'll be replying to all of them. And then let's go to the question and conclude on it. Okay, so Ephia said, please, you have answered it now. Thank you. Okay, you're welcome. Victor Droco said, good evening, sir. Good evening, Victor. You are welcome to the stream. So now that we have these computed, let's go back to our questions and let's try to calculate the sales volume variance, the sales price variance, and certainly let's do the yield variance as well in that case. So let me share my screen with you. Remember, the question has been posted on my Instagram page. So you can actually get a question from my Instagram page at Nhyira Premium. And if you're not following me on Instagram also, you can follow me on Instagram because that's where we post meeting details and various things that we'll be discussing. So let's go back to the question real quick and let's see what we're supposed to do there in relation to that. So look at the I aspect. That is what we want to go there for today now. It says calculate the following variances. I, sales volume contribution. Listen carefully. Sales volume contribution and sales price variances. Now, immediately the examiner says sales volume contribution, then it tells you that, the examiner wants you to use what? The marginal costing principle in here. So what it means then is that you need to know your standard contribution. Does it make sense? You need to know your standard contribution. So how do you know your standard contribution? Let's go back to the standard cost card so we can know the standard contribution. Now, if you check, you realize that the selling price is $12 Ghana cedis, 12 Ghana cedis per unit. And we see the direct material A there, we see direct material B there, and we see the labor cost there. So these are all variable costs. Since we are calculating sales volume contribution, we need to multiply it with what? The standard contribution. So let's multiply these up respectively to get some figures in that case. So wanted to grab my pen and my Casio so that we can go together. Right, so let's multiply them up. Since we are there, 2.5 times 1.7. Let's see what we got there. 4.25. So this is going to be 4.25. And then let's go to material B. 1.5 by 1.2. That's going to be 1.8. And then labor will be 0.45 times 6. And that's going to be 2.7. So let's add all the variable costs together. 4.25 plus 1.8 plus 2.7. And that is 8.75. So that's the variable cost, total variable cost, 8.75. So 8.75. So we take the standard variable cost from the 12, okay? And that gives us the margin of 3 Ghana cedis, 25 pesos. So my contribution is going to be 3.25 Ghana cedis. Does it make sense? That is our standard contribution in relation to that. That's how we calculate the standard contribution, because that 3.25 is what we are going to be using in the determination of the sales volume contribution variance. Now, if you remember the sales volume contribution variance I told you about, we are going to bring the budgeted units and bring the actual units. Then we'll take it at the standard contribution we just computed, 3.25. Okay? So if you check our budgeted sales from the question was, I think that was given below the question, 50,000. And then our actual sales was 48,000. So we strike the difference out, and that is going to be 2,000. Then we will take it at the contribution of 3.25. I hope it makes sense. So let's put that together on the board. I'm going to leave the shared screen in a moment. Then you can work together with me laterally. So let's see. So let's go through real quick. So sales, volume, contribution. Am I too up? Yes. Let me calm down a little bit. Sales, volume, contribution, variance. So remember, there are two keywords you have to pay close attention to. The volume means you are dealing with units. The contribution tells you that you are in the marginal costing school of thought. Okay, so those things are not just there for show. They are there for a purpose. So we're going to bring the budgeted sales. budgeted sales units, and that is given to us in the question as 50,000. And then we bring the actual sales unit. That's 48,000. You less it out, and you get 2,000 units as the difference. So it is this difference that you're going to be taking as the standard contribution per unit that we just computed, which is 3.25, if you remember. So you multiply it up to get a variance. Now, you need to ask yourself whether it is favorable or adverse, okay? So let me do 2,000 by 3.25, and that'll be 6,500 Ghana cedis. Now, is this favorable or adverse? Is this favorable or adverse? What do you think? Your budget says you should sell 50,000, but you sold 48,000. So you have sold less than you are supposed to sell. Because this is a revenue concept, we say this is an adverse variance. Okay? Because the sales is always about the revenue. So if you sell less than you should have sold, then it will lead to an adverse variance in relation to that. So that is the sales volume contribution variance. Assuming we are supposed to calculate the sales volume profit variance, which means we are in the marginal cost, we are in the absorption costing school of thought, then the fixed cost computation would have been included in the determination of our profits. Then we would have used that to multiply to get our variance in relation to that. So that is the sales volume contribution variance. Let's do the second one. And that is sales price variance. So the sales price variance, like I said, is the difference between how much we should have sold the actual units for and how much it actually sold for the period. So we sold 48,000 units. So 48,000 units should have sold. So we multiply that by the standard selling price, which is $12, okay? $12 from the question. So 48,000 by 12, and we get 576,000, okay? 576,000. But this sell for, how much did we sell it for from the question? Let's see. 580,800. 580,800. So what's going on here? Are we getting more revenue than we should have had, or less revenue than we should have had? If you look at it closely, you realize that we made more than we should have had. For that reason, this is going to be a favorable variance. You got it? So this is going to be a favorable variance. So put 580,800 minus 576,123. That's 4,800 Ghana cedis. 4,800 Ghana cedis. And that's favorable. Okay? That's favorable in relation to that. So that is the answer to the question when we talk about the issue in relation to the sales volume contribution variance and then the sales volume price variance, or the sales volume price variance in that case. Any questions, put it in the chat box, and then let's look at the last one, the yield variance. The yield variance. The yield variance. The yield variance could be computed in total or for each of the materials. Remember, there are two materials in here. That is why we are calculating mixed variance. We did that on Monday in the part 2. But there is also yield variance, and that is what we want to look at real quick. So let's see. Let's go. So I'm going to do for each of the products or each of the materials here, then we will do the total here, okay? So that we compare to see how we go about that. So that will be, let me go back to show you the question so that we know exactly what we're looking at here. Oh, that is a wrong file I'm sharing. Let's see, application window, where are we? Did I close this document? No, I didn't. So why can't I find you? Okay, think I find it. Okay. All right, so we're there now. So let's see. So now we are looking at the II, the yield variance for each of the material. That's what we want to look out for real quick in relation to that, okay? So let's go. So I'm going to do for each of them here, like I said, then I'll do in total here. So let's see. Now, when it comes to the material yield variance, remember I said we can do it in total and we can do it for each. So let's do for each here. So material yield variance. Now, the concept about material yield variance is about the output. Okay? So for the material A and B we have used, put together, how many units should we have had and how many units did we actually get? Okay, that is the concept about the yield variance. But like I said, we can do it in total and we can do it for each of them. So let's do for each of the material first. So when we are doing for each of the materials, this is how I'm going to go about it. So I'm going to put material A here. Is it material A? Yeah. And then material B here. Then I'm going to have the total here. You following me? Then we're going to bring in the standard mix in actual quantity. Standard mix in actual quantity. Okay? Then we bring in the budgeted quantity in standard mix. The budgeted quantity in standard mix. Now, I want you to stay close with me. Monday, that is in the part 2, we looked at how the standard mix in actual quantity is computed, okay? But I'm going to do it again here in relation to that. The idea is that you look at the actual material that has been used and add them together. So if we check, let me grab my calculator. For material A, we used 121,951 for A. Let me work that here, okay, together. We've done that already, but for the purpose of the people who haven't watched that, let's put it together so we get an understanding. So actual usage here is for A 121. For A 121,951. Then for B, it's 67,200. So you add the 2 up. and that gave us 189,151. Then we said to get the standard mix in actual quantity, we're going to use the standard usage. Now, if you go to the standard, each unit of the product A is 2.5 and B was 1.5. So when we add it up, that gives us 4, right? 4 kilograms. So we're going to use this 4 kilogram as the basis to do the sharing. So we're going to put this total here, 189,151, okay? Then standard mix in actual quantity. In other words, for the actual quantity that has been used, how many units should it have used in terms of the ratio of the usage on the standard? So that's going to be, let's bring in a fraction, 2.5 over 4 multiplied by 189,151. Boom. And we got 118,219 approximately, okay? 118,219 for material A, okay? Then for material B, same issue, but this time around we're going to use 1.5, and that is 70,932 approximately. 70,932 approximately. So that is how we get the standard mix in actual quantity. So you pick the actual usage, add them together, go back to your standard cost card, and then what? Use the per unit, add them together, and use that ratio and proportion. You did this in KG2, okay? You did this in KG2, ratio and proportion, KG2. So you just use that, and then you share it. Then you come to budgeted quantity in standard mix. The budgeted quantity in standard mix simply means how many units of the materials, how many kilograms of material should we have used in the actual units that has been produced. So back again, the actual units produced is 48,000. So if we are looking for material A, 48,000, material A will be 2.5. So 48,000 by 2.5, boom, that's about 120,000. So that's 120,000 kilograms, all right? Then, if you check for material B, that'll be 1.5. That's 72,000 kilograms. That is how we get the budgeted quantity in what? Standard mix. The budgeted quantity in standard mix. So let's put it down. 120 here. Remember, these are all in kilograms, okay? And then 72,000 here. So when you add it up, that will be 192,000. Then we get a difference. So let's get a difference respectively. And that's going to be 120, 123 minus 118, 219. That is 1781 kilograms. Okay. Then this will be 72,000 minus 70,932. That will be 1,063, something like that. 1,063 in that case. Now, is it favorable or adverse? Any ideas? Is it favorable or adverse? So let's check it out. The concept here is that based on our budgeted units, okay, based on our budgeted units, we should have used 120,000. But then, if we share the actual units used in terms of the ratio, we actually used 118,219. So the concept here is very, very critical. We should have used 120,000. That is what we speculated. That is what we thought that we should use. But we used 118. 200. So if you check here, this is the budget. This is the actual. So that's a favorable variance in relation to that. That's a favorable variance in relation to that. Why is it a favorable variance? Because we've used less than what we are supposed to have used based on the budget for the period. If you come to material B, we've used more, so that's an adverse variance right there in relation to that. But these are just differences. So you bring in the standard price per kilogram, okay, per kilogram, because these are in kilograms. And for material A, it is 1.7. For material B, it is 1.2. So we multiply up, and that gives us the variance. We multiply up, and that gives us the variance. So let's see what we got. $1,781 by 1.7, and that is $30.28 or Ghana cedis. And this one is going to be I'm trying to see what I'm missing, because I'm realizing that all these are less, so this is still favorable. Yeah, this is still favorable, okay? Because we should have used this, but we use this. We should have used this, we use this. So they are all going to be favorable in relation to that. They are all going to be favorable in relation to that, because we are using less in either case. Some of these things, if you are not careful to look at them very well, because based on the budget, these are the things we should have used. But based on the actual thing we used, you realize that we have used less than what we are supposed to have used. So that is why it will be favorable all out. So 1063 times 1.2, and that's going to be 1276. So favorable throughout, okay? So you add it up, and that gives us the total favorable in relation to that. So that is how we deal with the yield variance for each of them, okay? The standard mix in actual quantity, the budgeted quantity in standard mix, okay? The budgeted quantity in standard mix. We are seeing that in either case, what we should have wanted to have used are less than what we actually used, so it becomes a favorable variance. It makes sense there. It becomes a favorable variance. But if we want it in total, that's how we go. So II in total yield variance. So we will say that the actual material, 189,151 kilogram, should have yield. We divide that by 4.5 kilogram. Sorry, 4 kilogram. Do you remember 4 kilogram? 4 kilogram is from our standard cost card. On our standard cost card, A was 2.5 kilogram, B was 1.5 kilogram. So each unit uses 4, right? So if we use 181,151 kilogram, then it should have yield that divided by 4. Okay? So 189,151 divided by 4, and that's going to be 47,288, something like that. But they yield, what was the actual? We actually got 48,000, but they yield 48,000. So you realize that there is something favorable there. So we've got more than we should have had, so it's favorable. 48,000 minus 47,288, and that's 712, and that's the difference. Okay, that's the difference. Now, that is in units, okay? So that is in units. So we take this as the standard cost per unit in terms of the material, okay? The standard cost per unit in terms of the material in relation to that. Now, if you check from the material, from our workings we did, let me just share my screen back to you so you know how we pick that up. So, sharing my screen now. So we realize that material A was 4.25 when we multiply. Material B was 1.8. So when we add it up, that is 6.05. So that's how we get the standard cost per unit in terms of the material. So standard unit material cost. So standard cost per unit. And that's in Ghana cedis. So 6.05. So we multiply up, and that gives us the variance. So 6.05 by 712, and I'm getting 4308, something like that, Ghana cedis, and it's a favorable variance. So if you do it in total, you realize that you are getting a favorable variance. Right now, when you add these two up, 9 out of 10, it should be equal. If it's not equal, it will be because of approximation. 3028 plus 1276. Yes, close. Because of approximation, this is 4304 favorable. Okay, 4304 favorable. All right, it should be the same thing. But remember, we did some approximations in here, so that is why, and then we even approximated this upper. So that's why this figure is going up like that in relation to that. So this is how we deal with the material yield variance. For each of the material in total. Any questions, please? Any questions? Any questions for me? Okay, so that is it about this in that case. And this is where time will permit me to actually talk about. There is a C aspect of the question which says we should, what do? Prepare an operating statement that reconciles budgeted gross profit to the actual gross profit with the variances clearly shown. But because of time, I will not be able to touch on that. I will not be able to touch on that because of time constraints. I will not be able to touch on that because of time constraints, but we will find some other time and then we will see if we can come back to that in that case. So that is it about variance analysis. And I hope that you understand a couple of the concepts that we mentioned. I hope that you understand the way the questions were solved, the way the various figures were derived, and the way we went through everything in that case. Okay, so Efia is saying, please, the 6.05, how did we get it? We got that from the, let me take you back to the question. We got back from the standard cost card. So that is the standard material cost. So I'm sharing my screen with you so you can see it. We got that from above there. The material A is 2.5 by 1.7. So that gave us 4.25. And then the material B is 1.5 by 1.2. That gave us 1.8. So when we add the two up, 4.25 and then 1.8, that gave us 6.05. That is the standard material cost that we have there, or the standard cost per unit in terms of the material we have there in relation to that. Ifya, do you get it? That's how we derive that. Right, so that is it about this, and I will conclude around here today. Our on-campus man accounting class is going to begin in about 20 minutes, and so just going to prep myself for that as well in that case. So thank you very much for joining the stream. It's always a pleasure coming your way on the live stream. Remember that we are giving some offers out for students to be able to join us for our executive revision masterclass. So for a selected few students, you will be able to join and register for just 200 Ghana cedis per paper instead of the 325 Ghana cedis per paper that you would have paid. And so that is the issue there. You're going to be getting access to our full lecture video, like management accounting, everything we've covered in the last 14 weeks. You'll be able to get access to that. You'll get access to our question kits, our ebooks, and you'll be able to also join our Zoom sessions. And most importantly, you will get that one-on-one session with me where I assist you as and when you are studying and as and when you have any challenge to be able to prepare well for your examination. So if this is something that you are called out for, you can call or WhatsApp the number on the screen, 050-114-9296, 050-114-9296, and you register. This is for a limited time for a limited number of students as we prep ourselves towards the November 2020 examination. So thank you very much for joining the live stream. Thank you very much for those of you who were sharing the video. Thank you very much for those of you who were giving us a thumbs up on the video. It's always a pleasure coming your way, assisting you in order for you to prepare well for your examination. I'll come your way same time tomorrow as we continue with something else, probably another topic in another subject. But you follow me on Instagram, because in the morning that will be posted on my page, Instagram page, so you know what is to be covered for the day. Then you can prepare and join if it applies to you in that case. Also know that on the YouTube channel, we have over 450 videos already on the channel. So all you need to do is to check the playlist. If you check the playlist, you will get the videos. 9 out of 10 of the things you may be looking for have already been covered on the channel. So you just check it out so you can prepare well for your examination. So Ifya said, okay, thank you, sir. Okay, that's fine. Nicole said, thank you, sir. Stay blessed. All right, stay blessed to Nicole. So thank you very much for joining the stream. It's always a pleasure coming your way. I'll catch you same time tomorrow, 4:30 p.m. or 4:30 p.m. GMT. All right, GMT in relation to that. So thank you very much. I'll catch you same time tomorrow. So we meet again tomorrow. Stay blessed and stay safe. Bye-bye.